All right, guys, today we're going to talk a little bit about weak highs and weak lows and how to identify them. So what we have here, as you can see, I have a little doodle drawn out, is an example of what would produce a weak low. Okay, so you have that classic swing failure pattern like look here, where price was unable to close above a previous swing high in an uptrend, this being the uptrend. When you have a situation like this, technically speaking, because the job of this low failed to close above the high that created it, which is this high, and you have this swing failure pattern look, then technically speaking, this is now a weak targeted low. Now, this is the theory behind how market structure works. It's not going to be perfect. There is no 100% in trading, and I think most people that are watching this would know that by now. Now, in saying that, there are ways that we can apply this technique and have a better edge than just simply looking at a wick and saying, oh, because price was not able to close above, I'm just going to short it down to here and just assume that it has to hit this level, if not lower. Now, yeah, that will work sometimes, I'm sure. If it's in a high confluence area, volume's agreeing with the move, absolutely, you can do that. However, we'll be discussing and showing actual examples as to how this works as time progresses in this video. And we'll also show you ways to help get a better edge and confirm a weak low. Because right now, in my opinion, looking at this doodle, this would not be necessarily confirmed. Okay, it's an unvalidated weak low. I have my own tool, or my own strategy rather, that's actually quite simple on how to confirm a weak low. But before we get to that, let's take a look at what we have here on the Bitcoin chart. So starting from this high, because this is the most recent notable high, I'm on the 1 hour time frame, and I'm actually going to start my pull using the same technique that I taught you guys in lesson 1 and lesson 2 to go down from this high to the current low so we can see what the structure actually looks like before we do anything. So price came down. You had more than 2 up candles here in a row, so we're going to mark in our lower high because it was touched again right here from left to right. So price came down. Technically, this would have been a lower high as well, and then price came down. And look what happened here. You actually had a temporary shift in structure, it looks like. And then price said, you know what, I'm going to go lower. But before it did that, you had a wick on the low. Now, when you have this wick on the low, technically speaking, yes, this was a weak targeted high because it wicked. It was unable to close below the low, but notice how price never came all the way back up again. Now, despite this, I still have to draw in these points, even though they are wicks, because in theory, the new market structure break on the low would have to be under the wick itself. So we'd wait for a candle body close below this level, which you have received right here. And that would continue on with our market structure pull. So let's mark in that lower high, which is the highest point before this was touched again. And we have a lower low. 2 up candles in a row, we have a lower high. And now we have a lower low. So the theory behind this, and as I mentioned, it's not 100%, but the theory behind the whole weak low and weak high thing, it does make sense. When you start seeing this more frequently, it'll help you trade swing failure patterns much more effectively. And you'll kind of understand why I say in my streams that I generally do not trade older swing failure pattern levels. Like, how others may determine, hey, this is an SFP zone or a liquidity level. So instead of price just coming up like this and me entering a trade like that, even if volume does agree with the move, I'm not the guy that's going to be entering here. And the reason for that is because it doesn't relate to current market structure. So if this high, by SFPing a high like this, if it does not produce a weak targeted low for me, then I cannot justify entering a trade. It has to relate to current structure. However, if price were to come up like this, say on the hourly time frame or 4-hour time frame, it doesn't really matter on any time frame really, and then you have that same effect where price takes the high and then comes down lower with a wick, of course, then because that relates to current structure, you could wait for price to retrace under this low. Okay, and that's where you could enter the trade if it SFPs both of these levels, not just this one, but both of them, right? That would make it acceptable behavior to trade this because then it relates to this current doodle. Whereas it wouldn't relate to it any other way unless there's a local high. that is quite important. I want to clarify that before we go any further. And in this case here, we have a low, we have a lower high, and that lower high has not been taken out yet. It is a confirmed lower high because we went from left to right. Now, because this is not a break in market structure, but rather a swing failure pattern, I'm going to mark this out with an X. Very simple. So in theory, this would now be a weak targeted high. Let's see what happens. So in this case, this worked out wonderfully. So we took the high. Now we have a transition in market structure, right? So we can watch how price develops here, play it along a little bit and see what happens. So price came up, made a high, and possibly a higher low so far. Now look what happened here. Price decided to wick the high. Now, because the job of this low right here was to take out this high, being the lowest point, and because it failed to do so, this became a weak targeted low. Therefore, price came back to that low once again. So now we just SFP'd the low. We had a swing failure pattern on the low. So we can mark that off with an X as well. So we have an X on the low, we have an X on the high. So notice how price went from a weak low because it failed to take this high. That's not a close. Therefore, this was a targeted level. And then it flip-flopped. So now this is the targeted level. It's like a catch-22 if you think of it that way, right? So you had, a bullish move that flipped bearish, and now a bearish move that flipped technically bullish. So now in theory, we should come back to this high. Let's see what happens. So now we actually have a break in market structure. So this is a significant break. Others may see this as a range-bound environment, which is fine. That is a range-bound environment, and technically speaking, price is trying to break up from that range. Ranges are another beast on their own, and that's why I will have an entire section dedicated to range trading. I have many, many rules, and I will not be dabbling in that during the market structure series, because it's absolutely required that you guys understand the market structure side of things before diving into ranges. So in this case here, we have a higher high. I'm going to take it up to the top of the wick, despite the close being right here. I will take my structure point up to here, as long as it's a boss, a break of structure. You got your candle body close, excellent. So in this case, you still have to draw it up towards that wick, right? Because you still have to wait for this guy to break to continue the bullish overall trend. So let's see what structure has in store for us. So price came down, price came up, but notice something. Notice how we technically had an SFP right here. However, it didn't decline. It just went higher. So I'm sure some people shorted this clearly. You can tell they did because you have a black candle that followed or a bearish candle that followed. However, price is going higher. So quite obviously, this is not something that I would employ the use of in no man's land. We'll call it no man's land. I would use this in areas of what I deem to be support or resistance, or rather supply and demand. So if we're in an area in supply and demand, then yes, we can use this approach. So looking at structure, we're going to follow it through. We're going to have some failures. In this case, yes, we have a failure, right? It's a failure. Price goes higher. Let's see how this plays out. So ultimately, price went higher, and you didn't quite have two black candles in a row here. So from an hourly standpoint, technically speaking, this is not a valid transition in structure. So we're not going to force it, because that's a later lesson. We'll be doing multiple time frame structure pulls in a later lesson. And because of that, I'm not going to complicate this one. But as you can see, on a lower time frame, e.g., if you were on the 30-minute time frame, you more than likely had a confirmed swing point here, a confirmed swing point here, and another one here. So you had that effect where, because price was unable to close above this high, you came back for the low right here, the higher low, and then therefore closing below structure and transitioning lower time frame structure. This would not be present on the hourly time frame, but it would be present on the 30-minute time frame. So if you went back to the 30, then you'd have this, right? So in this case here, again, we're not going to force that. We're just going to look on the one time frame, because we're just trying to keep things basic, and we're trying to understand how these works and why they work the way they do. So if you actually notice, most notable moves have this kind of play where you have the effect of coming down, sweeping a low, or sweeping a high, and then ultimately coming to the other side, whether it be a range, whether it be an area of support and resistance, a very notable area. This is where you get those kind of moves, right? Before big moves like this, most often. So in this case here, you had the same kind of situation where you had this downtrend. You produced a lower high. Price came down and it swept that previous low, indicating that this is now a weak targeted high. Up you go. So the same kind of situation here. Nothing different. In fact, if we look at the very bottom on Bitcoin that we've had, and this is the area that we were just in actually, but if we go back to the very bottom of where Bitcoin bounced from last year, then you can see the same rules were applied. Let's go back. So if we're on the 4-hour time frame, you can see that price came down from this point here down to this point here. So we're going to draw that down. So price made a low, price made a lower high. What happened next is price came down and it swept that low, but it was not able to close below the low. And now it doesn't look like a sweep, but if I zoom in here, you actually went a little bit lower, right? Look at that. So we went a tiny little bit lower. Therefore, the high of the range, or the high in question, was technically a targeted level. So ultimately, price came back to that targeted level. But what happened when we hit that high is the question. Well, let's see. I'll mark this in with our X. And we have another X, right? So we swept that high. Therefore, this new low, in theory, is a targeted level. Now, ultimately, we didn't retrace that far back again. And the reason why we did not, and you wouldn't quite understand this as of now, is because we had a Wyckoff accumulation model. It was a model 2 Wyckoff where you had the 1, the 2, and the 3. Again, this will make sense later, so don't expect it to flow now. So in this case here, price made a significant retracement. And if I were to look a little closely, it came a little bit past the golden pocket here, it looks like, right, into an area of demand on a lower time frame. So because price retraced down, what that tells me is that, hey, this theory still worked. It just so happens that it was invalidated rather quickly instead, right? It was invalidated. The reason why it was invalidated was because price came down, price came up, it came down, it came up, and then you took the low, but then you closed above the high. So once that structure transitioned, it's the end of your weak level, okay? That's it. So let's actually look at how do we confirm a weak level and how do we get out of a weak level, meaning that if we are in a short or a long from what we see as a confirmation, what invalidates that confirmation prior to hitting the target? Because this is a good example right here, right? So in this case here, you swept a low, you swept a high. Price came up as such, where you made a higher high, a higher low. I'm actually going to ignore the primary market structure poll. We're going to take that most recent expansion leg. So going back to lesson 2, you would see this as your primary market structure poll. We went down, price went up. Everything between this point and this point was internal structure until one of these levels was touched again. And it just so happens the low was touched, therefore confirming the high. Because the low was touched first, it then confirmed the high. So this guy here confirmed this guy over here, right? And that's excellent. That's what we wanted to see. Generally, that's the way you would like it to flow in a downtrend, as it makes things a lot easier to take out the low before touching the high again, okay? So in this case here, that's exactly what you had. So because price came down, we're going to start with a structure pull from this most recent expansion leg low to this expansion leg high to where the SFP actually occurred. We're going to use a different color path tool for this. We're going to use red. We're going to use the 4-hour time frame, but again, there are ways to really dive into this using the internal structure that I showed you guys on the last lesson. However, you want to be a little bit careful using internal structure when doing this, because you don't want to go too far down, because the lower you go, the less likely it'll work, right? When it comes to higher time frame ranges. So that's something to bear in mind. So we had to move up, we had to move down. Price came up to this point, price came down to this point. You had an internal SFP here. Okay, you went from left to right, and then price came down and SFP to low, came up towards the high itself, right? This was the next highest point because this is not 2 black candles in a row. That's only one right there. So I can't use this, this, and this. At least I can't on the 4-hour. But perhaps on a lower time frame, we may be able to call that a primary internal break, meaning that it's coming from the range low directly up to where the SFP occurred in this little area here, okay? So let's actually check the 2-hour. We're going to divide our time frame in half. So on the 2-hour time frame, it appears that price went up here, down, up, down. I can leave most of the 4-hour pull. It's not really that concerning. We're only looking for where the transition actually occurred. And we can see something different here on the 2-hour. So instead of drawing this red line directly up towards the top, I'm going to draw it up to here. I'm going to say, okay, we have 2 black candles here. So that's a higher low, and this is a higher high. So there we go. We have a break in market structure from bullish to bearish. Now notice how I'm drawing 2 different break of structure lines out here. Instead of drawing it only from the bottom of this black candle from left to right, I'm going to draw that to where the wick occurred. Because price wicked that low, yes, in theory, this would have been a weak high. But because it just purged an even greater high, that overrules this. The higher market structure pull is overruling the lower time frame one, in this case here. And that's exactly what we have. Now, in this case, what we have here is a wick from left to right, where you would have drawn your X, okay? Because that's what you do when you have a wick from left to right. I usually draw the X template. So in this case here, for me to call this a break of structure now, I'm not going to continue from left to right and call this my bullish or bearish break in structure. I cannot do that whenever I see a situation like this, whether it's this way or it's this way. I have to count from here, okay? Because the wick invalidated this as a very important market structure point. Now I have to wait for the wick's point to be taken out. Very, very important, okay? We have to wait for the new low that wicked it out to be close below to call that a true transition now. All right. So we have our break in structure. We can ignore the bigger line here, or you can leave it on the chart. Maybe delete the BOS line on it so you're not confused with 2 of them. And now we can tell that, hey, we had a transition. This is what you need to see to confirm a weak low or a weak high. On whatever time frame that you're trading on,